Good morning, everyone. I'm John Newstreet, President and CEO of the Kissimmee, Osceola County Chamber of Commerce, where we are collectively champions for business and community. As a reminder, this is a Facebook live stream, and we have a great topic today. But if you have any questions throughout the live stream or even in the archived footage that we will air, we encourage you to put a question in the thread. We'll try to get to it during the show or address it as a follow-up to the comment in the thread. So please put your questions in the thread. All of these are archived on our website, KissimmeeChamber.com. We also have a YouTube page where you can see all of the topics we've covered in these live streams. So again, as champions for business and community, we want to bring you pertinent information to help make you a champion and succeed and overcome the situation that we have here with the pandemic and that we face in business every day. So today, we're going to talk about tax incentives that have come through the CARES Act. These are new. As a reminder, tax day has been pushed to July 15th, so we're just about a month away from having to file our taxes. Normally, that'd be April 15th. Now it's July 15th for this year. So in preparation in the next month, if you haven't already done it, we want to get you prepared. We have a great speaker, and she's going to tell you what you need to know as you prepare your filing. So we have with us Amy Fondo, a CPA with the firm CliftonLarsonAllen. She is a principal in the Orlando office. Amy Fondo is the Southeast Managing Tax Leader for CliftonLarsonAllen. Amy oversees the development, growth, and quality of the tax services line within the Orlando local office and participates in the tax service leadership team in the development and implementation of strategies, products, and market initiatives to fulfill the strategic dream for the tax service lines. She's a graduate of Marshall University and has over 18 years of experience in public accounting. She specializes in providing tax and consulting services to partnerships, limited liability companies, individuals, businesses, trusts, and estates with a specialization in international taxation. This also includes consulting on pre-immigration planning, global mobility, and tax planning for high net worth individuals. Her background includes directly overseeing the planning, performance, and review of tax engagements. As Christina brings her onto the screen, we'll welcome her, and I will turn the show over to her. Good morning, Amy. The show's yours.
Good morning, John. Thank you so much. I appreciate the opportunity to speak. So today we are going to be talking about the CARES Act. This slide indicates that it's for manufacturers. This just was from a presentation that we gave to a group of manufacturers. So actually, this is applicable to everybody. So if we can just advance the slide there. On our agenda today, mainly I think we will spend our time focused on the provisions as they apply to both individuals and businesses around the CARES Act. As John alluded to, there have been some changes to our common filing and payment deadlines that we will just go through briefly. And if we have any time left, we can just quickly touch on our approach to evaluating financial implications of COVID-19. And we can move on. So what is the CARES Act? That is the Coronavirus Aid, Relief, and Economic Security Act. That was signed into law by President Trump on March 27th. And it is the third phase of legislation that was aimed at fighting the COVID-19 pandemic and mitigating the related economic harm for families, workers, and businesses. Fun fact, it is the largest stimulus package in history with an estimated cost of $2.2 trillion. The CARES Act, among other things, does provide for recovery rebates to individuals. It expands and enhances unemployment benefits, extends loans and loans guarantees to eligible businesses, offers funding to the healthcare and education systems, and provides for tax relief for businesses and individuals. And that's some of the things that we'll be talking about today. So we can move on to the next. So the recovery rebate for individuals, that is a new credit that's applicable for 2020. That will have a maximum of a $1,200 credit for each eligible individual and up to $500 per qualifying child. There are AGI limits to this credit. And that will start at $75,000 for individuals, $150,000 for those who are married filing joint, and $112,500 for head of household. The way that this will work is that it is initially going to be based on your 18 or your 19 tax filings. If you have already filed your 2019 return, this is a credit that will be reported on your 2020 return. So if for some reason you were not eligible for the credit based on your 18 or 19 income, but you are eligible in 2020, then that credit can be taken on your tax return in 2020. And I think if we advance to the next slide, we can see that, an example there. So like I said, it is an advance refund of the credit based on 2019 if you have filed, or 2018 AGI based on those tax returns that were filed. Those refunds did start going out to the recipients on April 6th. And an example here is if you have a family of 5 with 2019 adjusted gross income of $200,000, and in 2020 that income is going down to $170,000. The way that we would see that presented is that family should receive an advance refund of $1,400. Maximum they could have received was $3,900. The credit in 2020, when they file their return, they will get an additional $1,500 because based on their 2020 income, they were eligible for that full $3,900. We can go to the next slide. Special rules for retirement funds. Typically, there is a penalty that is assessed if you take a contribution, or a distribution rather, from your retirement fund. There are provisions now based on the coronavirus relief. If you do take out a fund, it can, or take out it can be penalty free for up to $100,000 there. However, you are going to have to repay that back, and you'll have a 3-year period to repay. If you have a loan, that limit has been increased to $100,000, and there's a year of delay for that repayment. To be eligible for that early withdrawal penalty, you have to be diagnosed with COVID-19 by a test approved by the Centers for Disease Control and Prevention, or have a spouse or a dependent who has been diagnosed and experiencing adverse financial consequences because of the quarantine, furlough, layoff, work hour reduction, or the inability to work due to lack of childcare. We can move on. Defined contribution plans and IRAs. Once you reach a certain age, or 70 and a half, those required minimum distributions will start. In 2020, those have been waived. And I think that's just the important thing to know there. We can move on with that one. Charitable contributions under the CARES Act, for those taxpayers who are not itemizing but taking the standard deduction on their tax return, you can get up to a $300 above the line deduction for cash contributions that have been paid to a public charity. Again, that is only for non-itemizers. The contribution base for cash contributions for the individual itemizers will now be increased to 100% of your adjusted gross income. Corporations can now deduct up to 25% of their taxable income in charitable contributions. And for food donations, which typically had a 15% limit, that's been increased up to 25%. I think we can move on. Employer payments of student loans. So under the CARES Act now, there is a provision whereby employees can exclude up to $5,250 from income for student loan payments that have been made by their employers between March 27th and December 31st of 2020. This exclusion does appear to be available regardless of whether that student loan repayment has any connection to COVID-19. So that is just an additional benefit that an employer could provide to an employee. And that can be paid, as you can see here on this slide, to either the employee directly, or it can be paid to the lender. Next. So as we get into some of our corporate provisions now, what you'll find here is a lot of these provisions are going to make changes to the legislation that was put in place as part of the tax reform last year. So if you are familiar with these rules, the alternative minimum tax for corporations is no longer due to the tax reform that was put in place last year. Now, under the CARES Act, you can, for corporate minimum tax that had been paid in prior years, you can get that back. So the minimum tax credit that is refundable now in 2019, it was carried out over a period of years. You can now get that back in 18, and you can elect for a full refund of any minimum tax credit that was applicable to the 2018 year. We can advance the slide. So a delay of employer payroll taxes. So you can generally defer the employer share of your 6.2% Social Security tax on wages that have been paid from March 27th to December 31st of 2020. If you elect to do that, you have 50% of that payment that is going to be due 12/31 of 2021, and 50% that is due then on 12/31 of 2022. That is going to apply to the employer portion for those taxpayers who are self-employed as well, so not the employee portion, because they will have both. And it's not applicable if the taxpayer has received the Paycheck Protection Loan Forgiveness. So just that's the way to avoid the double dipping on that. We can advance. Employee business losses. This was another tax reform item that came out. And so under the employee business losses, there was a limitation of the amount of loss that could be taken on any particular year. So the way that worked is that for individuals, you could only deduct up to $250,000 or $500,000, depending on single or married filing joint. That has been suspended for the 2018 through 2018 years. Starting in 2021, wages will be considered non-business income as part of this business loss modification. Something we can go forward. Bonus for QIP. So this was actually an error that was accidentally, I think, created through tax reform. And what happened here is that prior to tax reform, certain items that were placed in service, so capital improvements, could be called qualified income property leasehold improvements if they met certain criteria. In an effort, I think, to actually increase what was considered QIP, there were changes that were made as part of tax reform, but where qualified improvement property used to have a 15-year life, useful life, which made it eligible for accelerated depreciation. What happened was that became 39-year property and was no longer eligible for accelerated depreciation. So the IRS made that technical correction through the CARES Act, and as you'll see there, qualified improvement property to the interior of the building is now how that is defined. It is not included as an enlargement to the space, an escalator or elevator, or any type of internal structural framework. It is going to be eligible now for 100% bonus that is retroactive into 2018. NA, if you elected out of bonus for that 15-year property in 2018, and also not applicable if you were elected or you were forced to use ADS. If you want to take advantage of this QIP for the 2018 tax year, then what you will need to do is file an amended return, an amended 2018 return, or if you want to make that change on your 2019 return, that's going to be considered a change in accounting method and would require what we call a Form 3115 that you could file with your 2019 tax return. We can go ahead and advance the slide there. Modifications to net operating losses. So as part of tax reform effective in 2018, you could no longer carry back your net operating losses, but those instead had to be carried forward and were subject to certain limitations. So carrying forward and also only available to take 80% of that loss in any given year there. So the change under the CARES Act is now going to allow for a 5-year carryback for net operating losses that were incurred in 18, 19, or 20. You can waive the carryback, but you can't modify the carryback period. So what that means is that you have to go back the full 5 years to where you first had income available there. You couldn't say, I just want to take that back into a 2-year period. The 80% limitation has been suspended through 2020. There is no change for the 90% limit for AMT. So we talked about how the AMT had been lifted for corporate taxpayers, but for those taxpayers who have a business that's a flow through and you're paying tax at the individual level, unfortunately, alternative minimum tax is still applicable at the individual level, and you can only take up to a 90% deduction there when you carry that back. NOLs generated in 18, 19, and 20, subject to 80% of the taxable income limit starting in 2021. And you do have, for your fiscal year taxpayers, a 2-year carryback for NOLs starting for a year that started in 17 but ended in 18. I think we can move on to the next slide. 163J limitation, again, a tax reform item here as well that's being changed through the CARES Act. So this provision, it did have a 30% limit to those taxpayers who were applicable on interest expense in 2018. That limit now is increased from 30% of your adjusted taxable income now to 50% of your adjusted taxable income for 19 and 20. You do have an amended return opportunity for your 19 returns. On partnerships, that limit does remain in effect at 30% for 2019 years. It's increased to 50% for 2020, and the 50% of the 19 excess interest is treated as paid in 2020. There's an election to use the 2019 adjustable taxable income in computing your 2020 limit, and the election will continue to use 30% if you want to remain using the 30% limit until instead of the 50. I think we can move on. The employee retention credit. This was something that was put in place for those employers who were experiencing some COVID-related quarantine, you know, that they couldn't pay their employee. They didn't have employees there for working. So the CARES Act did add a refundable payroll tax credit that's going to be equal to 50% of compensation that had been paid between March 13th and December 31st. To qualify here, your business had to have either operations that were fully or partially suspended due to a COVID-19 related shutdown order, or a gross receipts decline by more than 50% in the prior year. I will tell you, having listened to a lot of discussion on this, the rules are very specific, and it does take, I think, a lot of time working with someone who is very familiar with the HR rules, because it's just very, very specific. So this is one that I think if you believe that it might apply to you, you definitely want to have a thorough check on that, and then really understanding what the rules were regarding the quarantine, and what type of business you had, if those operations were fully or partially suspended. John, would you have something that you'd like to maybe add around this?
There I am. Well, I wanted to kind of remind the audience that we bring you a lot of information, and this is tremendous. When I first graduated college, a buddy of mine preceded me by a semester and got onto the workforce, and I said, how scary is it out there? What do I need to know? He says, well, college will teach you the vocabulary, and then the rest you'll have to learn on the job. So, seeing these acronyms and all these different things really give credence to the fact that you want good counsel and an accountant, which obviously CLA and Amy, you are, and you bring to the table. And I do have some clarification points, so I don't want to, we'll come back to this if you want to kind of finish the presentation as we kind of come close to time here. So.
Okay, yeah, no, absolutely. And that really was, this is something that's been really, it's ever changing, and it's very fluid. So this one in particular, I will say, I think that someone really does need to have a full understanding of, how their business was impacted, understanding also their employee structure as well, and who may or may not qualify for this. We can move on to the next slide. I think let's move on. We had talked about that one. Filing and payment deadlines. I think if we move on to the next slide there, John touched on this earlier, and really any taxpayer that was affected. So when we say person, we mean everyone and everything. So individuals, companies, and anybody that was affected, trust. You would have until July 15th. That covered whether you had estimated tax payments, tax filings. What wasn't covered were the payroll and excise taxes and the June 15 estimates on this. Now, I will say, because there had been a lot of question around the fact, if you had overpaid your estimate in July 15th, which would have been your April 15th, because a lot of people will have that overpayment, which then applies to your first quarter and second quarter, third, however far that takes you out into your estimated payments, that would be recognized. So when you made that July 15th payment, if it was the overage, it would go back and apply to that second quarter payment as well there. But July 15th will be the big date for getting those income tax filings in, and then if you had any planning items that you needed to do, that will cover your your estimated tax payments and things as well that you'll want to start working with your tax provider on. Estate tax returns were not delayed. You will see there that there were some added language around gift tax returns, so those were included as well. and also the 10% additional tax for early distribution of your IRA was relayed. I think that gets us really to the bulk of. I will just say in closing that with the CARES Act opportunities, there is a lot of opportunity there for timely cash tax savings. So you have amended return opportunities that are available for the following that we've talked about here. So your 5-year NOL carryback for losses that were generated in 18 and 19, which was 2 years if you had the fiscal year for the 17 year that ended in 18, repeal of the excess business loss rules for 18 and 19, the applicability of the 50% increase for your business interest limitations, and the big one that I think that we found a lot of taxpayers qualified for was the 100% bonus or accelerated appreciation for those qualified improvement property, the leasehold items that you might have placed in service in 2018 or 2019 that would otherwise have qualified for 39-year property that would not be eligible for accelerated appreciation.
Amy, tremendous information. I got a few questions we'll try to address. I don't see any coming into the live feed, and if we can, try to honor our 30-minute mark. But if we go over, that's fine, because to help our businesses. So speaking for the viewers and maybe seeking some clarification,
Sure.
Myself, one of the early slides you had talked about a rebate, and it said a credit of the 1,200 or the 500, and some people receive checks. And so is that when you say it was an early rebate, they may have gotten that check, or do they get that check and still get to maybe have it as a credit on their taxes? Can you clarify the?
Yeah, absolutely. Yeah, that can be a little bit confusing. So the check that you would have received is considered an advance payment. If, we talked about the fact that when you report that in 2020, if you were eligible for the full credit on your 2020 return, the full, so meaning the difference between what you received versus what you would be eligible for on your 2020 return. Now, one thing I think that's also important to point out, because we talked about the reverse here, if for some reason you file your 2020 return and your income has now increased, and so the advance payment that you received is actually more than what you would be eligible for on that 2020 tax return, you will not be penalized at that point. So you wouldn't have to pay back, but if you were eligible for more, that would be reported then and credited on your 2020 return. So the money that you received now is an advance payment of that.
Okay, thanks for that. You also mentioned 10% additional tax on, and I may be jumping around from your presentation.
No, go right ahead.
A 10% additional tax on early distribution of IRA. I thought they had waived all early distributions, or can you just explain that further, that there may be a penalty if you've done that, or how does that relate?
So typically, if you there are limits on when you can start taking out distributions from qualified plans. If you take a distribution out, then typically what you have is an additional penalty on top of the taxes that you would have to pay for that. So while the penalty, yes, is waived, assuming that you meet the criteria there, the one thing is you do have to pay the money back. I think that was one of the things that was important to note there, that in order to receive that benefit, that you do have a period of time that you have to pay that back.
Outstanding. Two more questions. The employee tax credit that you talked about, you led off saying this was geared originally towards manufacturing, but applies to all. But it sounds like that employee tax credit may be extremely beneficial to tourism industry. And so I wanted to see if you had thoughts that, yes, that's true. It'd be great for them, or it's great for all, but definitely, because if we can share some of this information at targets to say you can really win with this, then as the chamber, we want to follow up on that.
I feel like this is an area where you really could spend the whole 30 minutes talking on this topic. We at CLA, I will say, have put a lot of time and resources and energy into all of the efforts and relief that has been provided as part of the virus. Tax incentives are one, but also a lot of, loan funding and other things that are just outside of, the tax piece. And I'll get to the tax credit here, because I'll say, so what we have developed is we have a live stream series that we have every Tuesday and every Thursday. You can go to our website, claconnect.com, and you can see topics that we have discussed specifically around this employee tax credit. I think a lot of people, so I'm just going to be 100% transparent here. Most people were looking at the loan, so I've only had the opportunity to really dive in and try to look at this of my clients, and that's where I say I think you need to have somebody who is really well versed in understanding this, understanding first of all what were those rules in your particular jurisdiction. So were, and then that gets into things like, were you an essential business? You weren't. Because it's very specific on how your business was impacted in that particular area. So I do think the answer, could be yes there. But again, if we think that this would be a topic that might be applicable to a larger base, I think this is something that you could spend the entire 30 minutes going through and talking about, because it just does get that specific on the employee tax rules, as well as, and very specifically, how your company was impacted.
So it brings us back to making sure you've got a good accountant to help.
Absolutely.
Very good. The last question I had, because we talk about corporations, but there's different structures, LLCs and S Corp, et cetera. So is it fair to say this is relatively uniform, or we were talking specific to C Corp and other things may vary for other classifications?
I think this is. It's pretty uniform. I think you saw on there that some of the things when we started talking about the business limitations around interest, there were some different rules there for partnerships. I think that was why it's important to understand the treatment from a corporate to an individual perspective, because while a C Corp pays tax at that corporate level, you have flow-throughs that pay tax at an individual level. And so really needing to understand the different nuances there between that corporate and the individual level, because then we get into things like alternative minimum tax, for example, that wasn't applicable at a corporate level anymore. It still is at an individual level. So you just need to really understand where you're paying tax, and then understanding the full rules about how that works and applies to you specifically.
And did you say that you had a recorded video already that talked about that employee tax credit?
Absolutely. So I would send people to our website, CLA Connect, and directly on the face of the website there you will see what we have called our live stream series, and you'll be able to go back and look at the catalog of all of the previous sessions where we have spent a lot of time around the loan updates, as that has been ever changing, helping to understand how to properly size those loans, gotten into the forgiveness now that is the hot topic, as people are trending towards those dates of having to look at what the forgiveness might be. There's been some extensions there, some additional relief, but then also talking about liquidity, and then specifically, yes, as it relates to those employee tax credits and how that taxpayers might be affected by that.
I see that Christina has posted that in the thread too. So the website's there in the Facebook thread for people to click and follow up on that. I think we'll end it with that unless you have any closing thoughts. We certainly appreciate your time and expertise, sharing it with our members and helping make sure we survive this together and come out stronger.
No, again, I appreciate your time. These are all very complex items. I think it's a year of reform on top of reform. So there are a lot of intricacies in here. Definitely want to make sure, though, that you reach out to your tax provider, because there certainly are a lot of savings out there right now as well that you can take advantage of.
Super. We appreciate you, Amy, and all the information's down there in the thread to follow up with CLA as a competent accountant to help you through all this. And we'll talk to you next week for our viewers. But Amy, can't thank you enough for being with us today. Thank you.
Awesome. Thank you.